Welcome back to Investing Talk Podcast. Sometimes you come across a company and it just grabs your attention. And today we're going to look at one of those. Simple. It's a robotics company.
Yeah.
And it's been on a real roller coaster ride this past year.
Yeah, that's right. Simple, ticker symbol SPPL, has seen its stock price swing dramatically. From a low of 25 cents to almost $7, it's been a wild ride. Which kind of begs the question, what's driving this volatility?
Well, one thing that jumps out to me is the recent revenue figures. They're sitting at about $4.69 million, which sounds pretty healthy at first glance.
It does sound promising. But it's important to dig a little deeper. Simple also has what analysts call considerable retained losses. It's a bit like if you opened a fantastic bakery and you're selling out every day, but you've also taken out a big loan to get the ovens and all the fancy equipment, you're bringing in cash.
Yeah.
But you still have that debt hanging over your head.
Okay, so that's what retained losses mean. It's like that bakery loan. You're making sales, but you still have to pay off the debt you incurred to get started.
Exactly. And this is where those high leverage ratios come into play. You see, to achieve rapid growth, Simple has used debt and other financial tools, leverage, to expand quickly. This can be a risky strategy. It raises the question of whether their current revenue can support their debt, and if this growth is sustainable in the long run.
So it's not just about how much money they're making now, but how they're managing their finances for future success. Speaking of the future, they've got this new product called Gemini that's generating a lot of buzz. It's not just a one-trick robot either. This thing is designed for security, concierge services, and even cleaning.
And the timing couldn't be better for Simple. The global service robotics market is projected to grow at an incredible pace, a compound annual growth rate of over 30%. This means that the market for robots like Gemini is estimated to reach almost $90 billion by 2028.
Wow, that's huge. It seems like Simple is strategically positioning itself to capture a significant chunk of that market, and they're not putting all their eggs in one basket. They've also been forming strategic partnerships, like their collaboration with Evolve Consulting, a company focused on building automation systems, and Mode Technology, based in New Zealand, to specifically boost revenue.
It's a smart move by diversifying their offerings and expanding their reach through these collaborations. Simple is demonstrating a proactive approach to growth. These partnerships bring valuable expertise and open doors to new markets.
It definitely paints a picture of a company that's thinking ahead. And speaking of thinking ahead, remember how we talked about those financial concerns? Well, Simple has managed to regain compliance with Nasdaq's minimum bid price requirement.
That's a significant win for Simple. When a company's stock price falls below the minimum bid price for an extended period, it risks being delisted from the Nasdaq exchange. Regaining compliance sends a reassuring message to investors, signifying their commitment to stability and responsible financial management.
It's a good sign for sure. But we have to remember the bigger picture. Market expert Rujir Sharma has predicted some potential headwinds for the U.S. stock market in 2025, citing rising debt concerns as a possible drag on economic growth.
Sharma's prediction raises a valid point, and it's something investors should be aware of. It underscores the interconnectedness of the market and how broader economic trends can impact individual companies. However, even with these concerns looming, there's a surprising amount of optimism surrounding Simple.
Analysts are actually quite bullish on SPPL. We're seeing price targets ranging from $2.72 to $7.35 for 2025.
Those price targets are certainly eye-catching, especially considering the stock is currently trading at just over $1. But it's critical to approach these projections with caution. Simple still faces those financial risks we discussed earlier, and its success will hinge on their ability to execute their growth strategies while effectively managing their debt in a potentially volatile market.
Right. It's important to be aware of both the potential upside and the risks involved. Now, for those of you who like to delve into the technical side of investing, let's take a look at some of Simple's key indicators. When we examine the moving averages, we're actually seeing some conflicting signals. The shorter-term moving averages, such as the 5-day and 10-day, are suggesting it might be a good time to sell.
However, if we zoom out and look at the longer-term moving averages, like the 50-day and 200-day, they're pointing towards a buy signal. This conflicting information suggests that there's uncertainty in the market about Simple's short-term direction.
So how can investors make sense of these mixed signals?
It's important to consider your individual investment horizon if you're a short-term trader. Those shorter-term moving averages might carry more weight in your decision-making. But if you're looking at Simple as a potential long-term investment, those longer-term averages could be more relevant to your strategy.
That makes sense. Different time frames call for different approaches. Let's move on to other indicators like the RSI MACD, stochastic oscillator,
Yeah.
and Williams percent R. Each of these uses different calculations to analyze price trends, momentum, and overbought or oversold conditions.
Right. And these can give us a more comprehensive view of market sentiment and potential price movements. For instance, the RSI, or Relative Strength Index, is currently hovering around 54.53 for Simple. This indicates a relatively neutral position, suggesting that the stock is neither significantly overbought nor oversold.
So no major warning signs there. What about the MACD?
The MACD, or Moving Average Convergence Divergence, is giving us a buy signal for SPPL. It's currently at 0.15, suggesting that there might be some upward momentum building for the stock.
Interesting. And what are the stochastic oscillator and Williams percent R telling us?
Both the stochastic oscillator and Williams percent R are also flashing buy signals. The stochastic oscillator suggests that Simple might be in oversold territory, meaning it could be undervalued. And the Williams percent R reinforces this sentiment.
So we've got some buy signals from the MACD and the oscillators. But remember, those moving averages are painting a bit of a mixed picture. To help us navigate this, we need to look at simple support and resistance levels.
Absolutely. Think of these levels like guideposts for the stock price. They give us an idea of where the stock might find support, buyers stepping in, or face resistance, sellers taking over. For Simple, we've identified a support level at around $1.01. This means that the stock might find some buying support if it dips down to that level.
And what about the resistance level?
We've identified a resistance level at around $1.14. This suggests that the stock might encounter some selling pressure if it attempts to break through that price point, so we have a range to watch.
It sounds like Simple's technical picture is as dynamic and complex as its financial journey. It'll be interesting to see how these indicators play out in the coming weeks.
Indeed, we'll be keeping a close eye on those. And in the next part of this episode, we'll delve deeper into Simple's recent achievements, their ambitious growth strategy, and the challenges they'll need to overcome to truly solidify their position in the robotics market.
It's a fascinating story that's still unfolding. We'll be back in a moment to continue our discussion on Investing Talk Podcast.
Welcome back to Investing Talk Podcast. We're continuing our look into Simple, ticker symbol SPPL. And now, we're going to shift our focus to their recent achievements and their ambitious plans for the future. You know, it's important to look beyond the numbers and understand the company's strategic vision.
That's right. You know, we've talked about the roller coaster stock performance and the financial hurdles they've faced. But amidst all that, Simple has also achieved some pretty significant milestones. One of the most recent wins has been regaining compliance with Nasdaq's minimum bid price requirement. This was a close call for them.
Absolutely. Falling below that minimum bid price for an extended period can be detrimental, especially for a company striving to establish itself in a competitive market. Regaining compliance demonstrates, Simple's commitment to stability and responsible financial management, which is a crucial signal to investors.
It shows they're taking the necessary steps to secure their financial footing, which is essential for their long-term growth. Speaking of growth, Simple's CEO, Norman Schroeder, recently issued a letter to shareholders outlining their achievements and future plans. It's like a sneak peek into their strategic playbook.
And in that letter, Schroeder highlighted some key achievements from 2024, including the launch of their multifunctional robot Gemini and their efforts to expand internationally. They've set up operations in Australia and are actively building distribution partnerships in several other countries.
That international expansion is a bold move. But it also makes sense if they want to capitalize on the projected growth of the service robotics market worldwide.
Precisely. It's a strategic move to position themselves for global reach. In that shareholder letter, Schroeder also addressed the elephant in the room, regaining Nasdaq compliance. He framed it as a vital step towards ensuring Simple's financial stability, a foundation for future growth.
So they're not shying away from the challenges they face. They're acknowledging them head-on and taking concrete steps to address them.
Exactly. And that transparency is essential for building trust with investors. Actions speak louder than words, and Simple is demonstrating a commitment to responsible growth. Now, let's dive a little deeper into the world of robotics and explore why Simple is so well positioned to capitalize on the industry's explosive growth.
The service robotics market is projected to grow at an astounding rate. And Simple, with its innovative products and strategic partnerships, is poised to be a major player in this arena. It's like being at the forefront of a technological revolution.
And their multifunctional robot Gemini is a game changer, designed to handle security, concierge services, and even cleaning. Gemini is a versatile solution for various sectors, including hospitality, healthcare, and even residential applications.
It sounds like the Swiss Army knife of robots. It has the potential to revolutionize how businesses and individuals approach everyday tasks.
The possibilities are vast, and Simple is betting big on Gemini to be a flagship product. That drives their growth in the service robotics market.
But even with innovative products and ambitious plans, every company faces challenges. What are some of the hurdles Simple will need to overcome to truly thrive in this competitive landscape?
Well, the first hurdle is financial. Those considerable retained losses and high leverage ratios we discussed earlier can't be ignored. Simple needs to prove to investors that they can manage their debt effectively while pursuing their growth strategy. It's a delicate balancing act.
It's a tightrope walk between aggressive expansion and financial prudence. What are some of the other challenges they face?
Beyond the financials, Simple will need to navigate the intensely competitive landscape of the robotics industry. There are other established players vying for market share, some with deeper pockets and a longer track record. Simple will have to differentiate itself and demonstrate its unique value proposition to stand out.
Competition is fierce, and innovation is relentless in the tech world. They'll have to stay ahead of the curve. How do their strategic partnerships factor into this?
That's where those strategic partnerships with companies like Evolve Consulting and Mode Technology become crucial. These collaborations provide Simple with access to new technologies, expanded market reach, and valuable expertise. They're building a network of allies to help them navigate the complexities of the global robotics market.
These partnerships can help them leverage the strengths of others and accelerate their own growth. But partnerships alone won't guarantee success. What else is crucial for Simple's long-term success?
Execution is key. Having a great product and a solid plan is one thing, but bringing it all together and delivering on those promises is another. Simple needs to demonstrate to investors that they can execute their strategy effectively and translate their vision into tangible results. It's about turning potential into real-world success.
It's about turning vision into reality. And despite the risks and challenges, there's a lot of optimism surrounding Simple and its potential for growth.
Absolutely. Despite the financial risks and the competitive landscape, analysts are projecting some impressive price targets for Simple in 2025, ranging from $2.72 to $7.35. Remember, the stock is currently trading at just over $1.
Those price targets are certainly enticing. But, as we always emphasize, it's crucial to approach these projections with a healthy dose of skepticism.
Analyst predictions are just that, predictions. They're based on models, assumptions, and data analysis. But they're not guarantees. It's essential to conduct your own research and due diligence before making any investment decisions.
We always encourage our listeners to do their own research and not solely rely on analyst predictions. And it's important to consider the broader market context as well. Market expert Ruchir Sharma predicted that the U.S. stock market might underperform in 2025 due to rising debt levels and a cautious outlook on economic growth. How might this affect a company like Simple?
That's a valid concern, and it underscores the fact that even the most promising companies can be impacted by macroeconomic headwinds. A potential slowdown in the U.S. market could impact Simple's growth trajectory, especially if they're heavily reliant on the domestic market for revenue.
So even though Simple is expanding internationally, the health of the U.S. market is still a significant factor to consider.
It's all interconnected. It's like sailing in potentially choppy waters. Even with a great ship and a skilled crew, you have to be prepared for unexpected storms.
That's a great analogy. Investing requires careful navigation and a thorough understanding of both the potential rewards and the inherent risks.
Exactly. And before we wrap up this part of our discussion on Simple, let's recap some key takeaways for our listeners. Simple is a company with a compelling story, operating in a high-growth market, armed with an innovative product in Gemini, and taking proactive steps to address its financial challenges.
It sounds like an exciting company with a lot of potential, but also some inherent risks that investors need to consider carefully. What's the most important takeaway for our listeners today?
Do your research. Don't just rely on headlines or analyst predictions. Dive into Simple's financials, understand their growth strategy, and carefully consider the risks involved. Then decide if their story aligns with your investment goals and risk tolerance.
That's such great advice. Now let's move on to the technical analysis of Simple stock performance. In the final part of this episode of Investing Talk Podcast, welcome back to Investing Talk Podcast. We've covered a lot of ground in our discussion about Simple, ticker symbol SPPL, from their roller coaster stock performance and financial challenges to their innovative products and ambitious growth strategy. Now, it's time to wrap things up by looking at some of the technical aspects of their stock, those indicators that can provide insights into potential price movements.
Right. Technical analysis can be a valuable tool for investors, especially when combined with a thorough understanding of the company's fundamentals.
We've already touched on those intriguing moving averages, which are sending us some mixed signals. Remember, the shorter-term averages, like the 5-day and 10-day, are hinting at a possible sell signal, while the longer-term ones, such as the 50-day and 200-day, are pointing towards a buy.
Yeah, it's like getting conflicting advice from your friends on whether to buy a particular stock. It can be a bit perplexing, but it highlights the importance of considering your own investment horizon.
So how should investors interpret these conflicting signals? What questions should they be asking themselves?
Well, it boils down to your individual investment goals and time frame. If you're a short-term trader looking for quick gains, those shorter-term moving averages might be more relevant to your decision-making. But if you're a long-term investor with a longer time horizon, those longer-term averages might hold more weight in your analysis.
So it's all about aligning your strategy with your investment goals. Now, let's move on to the RSI, or Relative Strength Index, which helps us gauge whether a stock is overbought or oversold. Simple's RSI is currently hovering around 54.53, which indicates a fairly neutral position.
Yeah, that's right. The RSI suggests that. Simple isn't flashing any major warning signs of being excessively overbought or oversold at the moment.
Yeah.
It's like a car cruising comfortably at a steady speed.
Okay, so no need to slam on the brakes or hit the gas just yet. What about the MACD, or Moving Average Convergence Divergence? What signals is that giving us?
The MACD is currently flashing a buy signal for SPPL, sitting at 0.15. This suggests that there might be some upward momentum building for the stock.
That's an interesting contrast to the shorter-term moving averages we discussed earlier. What other indicators are worth looking at?
We should also consider the stochastic oscillator and the Williams percent R, both of which are currently giving us buy signals for Simple. The stochastic oscillator suggests that the stock might be in oversold territory, potentially undervalued, and the Williams percent R echoes that sentiment.
So, we're seeing some positive signals from the MACD, the stochastic oscillator, and the Williams percent R, but we still have those mixed signals from the moving averages. How do we make sense of this complex technical landscape?
Well, that's where support and resistance levels come in. These levels act as potential floors and ceilings for the stock price, giving us an idea of where buying support or selling pressure might emerge. For Simple, we've identified a support level at around $1.01 and a resistance level at $1.14.
So we have a range to watch. If the stock price dips down to that support level, we might see some buyers stepping in. And if it tries to break through that resistance level, we might see some sellers taking over.
Exactly. These support and resistance levels can be valuable guideposts for investors, especially for those who are more technically inclined.
It sounds like Simple's technical picture is as dynamic and complex as its financial journey. What's the overall takeaway for investors who are considering adding Simple to their portfolio?
Well, the current recommendation for Simple is a hold. We're seeing some bullish signals from certain indicators, but we also have those mixed signals from the moving averages. And we can't forget those financial risks we discussed earlier.
So it's a wait-and-see situation. What's the most important piece of advice you would give to our listeners who are interested in Simple?
Do your research. Don't just rely on headlines or analyst predictions. Dig into Simple's financials. Study their growth strategy, and carefully consider both the potential rewards and the inherent risks. Ultimately, the decision of whether or not to invest in Simple depends on your individual investment goals and a risk tolerance.
That's excellent advice. Investing is a personal journey, and each investor needs to chart their own course based on their individual circumstances and goals. We hope our discussion on Investing Talk Podcast has provided you with valuable insights and a deeper understanding of Simple's story. And as always, we encourage you to stay informed, do your research, and invest wisely. If you enjoyed this episode, please subscribe, share it with your fellow investors, and leave us a comment with your thoughts on Simple's future. We love hearing from you.